2022 has been a turbulent year in markets. As the year draws to a close, we'd like to share with you some insights as to where investors are putting their money. In Australia, exchange-traded funds represent a relatively small but increasing share of the investment universe. Far more money still sits with unlisted managed fund vehicles. It's only been 10 years since ETFs started to get traction with investors in this country, but investment flow data highlights a telling trend. Comparing aggregate flow data for the year to the end of November, unlisted managed funds have had their largest year of net outflows on record. ETFs, on the other hand, are on an unbroken run of positive net inflows. With $12.5 billion of net inflows so far this year, it'll very likely be the third best year for inflows that the ETF industry has experienced in this country. This stark difference in the fortunes indicates that more and more Australians are switching from using unlisted managed funds to ETFs for a whole myriad of reasons. Looking more closely at where investors were allocating their money within the ETF landscape, we saw that as an asset class, Australian equities received the highest inflows. Within Australian equities, broad market low-cost index funds received the lion's share, nearly $3 billion. Vanguard's broad market Australian equity fund received the most inflows of any ETF. A200, BetaShares Australia 200 ETF, received the second most flows. Global equities have traditionally been the biggest ETF asset class by inflows. But in 2022, the aggregate net flow figure was significantly reduced by a very large outflows from an active global equity fund that had only recently converted from an unlisted fund into an ETF. If we exclude the outflows from that one fund, global equities has again been dominant. Within global equities, there are 40 actively managed ETFs. However, very few of these attracted meaningful inflows in 2022. Instead, investors allocated capital to low-cost index funds, core portfolio allocations. Another really interesting dynamic was investors electing to switch from unhedged global equity ETFs into currency-hedged global equity ETFs in October, when the Australian dollar fell to below 65 US cents. Pleasingly, many investors were able to time that switch very well, with the Australian dollar recovering since that point. In Q1, in fixed income, investors expressed a preference for the higher yields in fixed-rate bond ETFs. And cash ETFs, like AAA, our BetaShares High Interest Cash ETF, and floating rate bond ETFs, saw significant outflows. However, after cash rates rose and government bonds sold off in the first half, cash and floating rate bond ETFs returned to favour in Q3. In Q4, we're seeing strong support for both fixed and floating rate bond ETFs. Ethical ETFs have continued to see strong support, with ETHI, our global sustainability leaders, and FAIR, our Australian Sustainability Leaders ETFs, being amongst our top funds for inflows. When looking at ETF performance in 2022, there were three key performance drivers. One, strong commodity prices acting as a tailwind for commodity-related investment exposures. Two, central banks hiking cash rates more aggressively than what was priced into fixed income markets, causing fixed-rate bonds to sell off in the first half and placing downward pressure on equity valuations. And three, US dollar strength due to the higher rate environment and less dire growth outlook for the US relative to other global safe haven currencies. With every global equity sector in the red except for energy, it's not surprising that fuel has been the best performing fund, with a return of 47% year to date to the end of November. We saw net outflows in that fund as investors look to take profits over the year. US equities and growth equities have been hardest hit by the higher rate environment. Hence, leveraged short US equity ETFs are amongst the best performers for the year, with the flip side being the leveraged long US equity ETFs appearing in this year's biggest losers. Australian resource sector ETFs, which hold stocks from the materials and the resource sectors, did well. Broad market Australian equity ETFs have recovered to be in positive territory as at the end of November, helped out by those large allocations to resources and financials that also fared reasonably. And US dollar currency exposures, such as BetaShares USD, and the leveraged Yank ETF have also performed very strongly so far this year. Some of the most disappointing returns came from our Crypt fund that holds companies that operate in the crypto economy, and from ETFs with direct exposure to Bitcoin and Ethereum, which were only launched partway through the year, so they don't appear in our performance table. That's a wrap for 2022. It's been an unpredictable year, and I'm sure markets will continue to keep us guessing in 2023. In any event, we believe that the secret to building wealth is creating a long-term investment plan and sticking to it over the cycle. We believe ETFs offer an excellent tool for building low-cost, diversified portfolios in all market conditions, And based on the flow data, it would appear that more and more Australian investors are seeing the advantages. On behalf of everyone at BetaShares, thank you for your support in 2022, and we hope you enjoy your end of year break.